Okay, so I want you to picture a machine, not, a car or a computer, but something massive. Imagine a machine that's basically the size of the entire economy. It has these gears that are just quietly turning in the background of every single transaction you make. Every time you swipe a card, every time a business signs a lease, this machine is humming along. And sitting at the controls, there's this entity that, well, it really prefers to stay in the shadows.
That is a very ominous way to start a Tuesday.
I aim for dramatic effect. But seriously, we talk about the economy like it's the weather, right? Something that just sort of happens to us. But today's deep dive is about the people who actually try to control the weather. We are looking at the central bank. And we're doing this by tearing into a really dense but fascinating collection of notes titled The Central Bank, Architect of Monetary Equilibrium.
And despite that very dry title, it's basically a user manual for the modern world. It's funny you use the weather analogy because the source material makes a point right at the start. The central bank isn't just, observing the climate. They are actively trying to set the thermostat.
Exactly. And the mission for this deep dive is to get past the headlines. We all know the central bank raises rates. We hear it on the news all the time. But our goal today is to understand the mechanisms under the hood. How does a room full of people in suits deciding on a percentage point actually change the price of my groceries or the value of my house?
And that's where the complexity lies. It's not a direct line. It's a game of incentives, psychology, and really plumbing.
So let's start with the identity crisis. The text calls the central bank the bank for banks. And I think this is the first hurdle for most people. If I walk up to the Federal Reserve or the ECB, knock on the door with a bag of cash, they won't let me open an account.
No, they would probably call security. The source material highlights this paradox really explicitly. It says the central bank doesn't work with ordinary people. There's no retail counter. Their client list is incredibly exclusive.
Who is it?
It's the commercial banks, the big institutions where you actually do your banking,
Yeah.
and the government itself.
So they're the wholesaler, and our local banks are the retailers.
That's a pretty good analogy. Yeah. They provide the raw material, which is money, that the rest of the banking system then sells to us. But their goal isn't profit, which is the weird part. If they aren't trying to make money, what are they trying to do? And the text lays out what it calls the twin mandates,
Right. Mandate number one, price stability.
which is really just code for fighting inflation.
Okay.
Correct. They want your money to hold its value. They don't want you rushing to the store today because you're terrified that bread is going to cost double tomorrow.
And mandate number two, supporting sustainable economic growth. They want businesses hiring, factories running. Now, here is where I get stuck, and I think a lot of people do. The source material presents these as twin mandates, implying they go hand in hand. But in reality, aren't they often enemies?
You've just hit on the central tension of all monetary policy. The text definitely alludes to this friction. I mean, in a perfect world, sure, you have high growth and low inflation. But in the real world, those two things usually move in opposite directions. Think about it. If you want maximum growth, everyone employed, wages rising, factories running 24/7, what happens?
Demand goes up. Right.
People have money, so they start buying stuff.
And when everyone is buying stuff, supply gets crunched and prices go up. That's inflation. So if the central bank pushes too hard on that growth mandate, they fail the price stability mandate.
And if they do the opposite, if they focus entirely on killing inflation, just crushing demand so prices stop rising, then businesses stop selling things and they lay people off. So they fail the growth mandate. Exactly. They are constantly walking a tightrope. The source uses that term architect of equilibrium. They aren't trying to win. They are trying to keep the system from falling off either side of the rope. They want the economy to run hot enough to create jobs, but cool enough to keep prices stable.
So let's talk about the tools. How do they actually walk this tightrope? The source material references an analyst named Sean who uses the gas and brake analogy. It's a classic, but I really want to get into the mechanics of it because the simple version misses the nuance. The main lever here is interest rates.
Right. This is their primary control panel.
Okay, so the gas pedal. This is lowering interest rates. The standard explanation is rates go down, loans get cheap, people buy things. But let's go one layer deeper. Why does this actually stimulate the economy? It's not just about credit cards.
No, not at all. It's about what's called the hurdle rate for investment. Imagine you're a CEO of a massive company. You're thinking about building a new plant that costs, say, $100 million. And that plant is going to generate a return of, let's say, 5% a year.
Okay, so I make 5% on my money.
but you have to borrow the $100 million to build it. So if the central bank has the interest rate set at 7%, are you going to build that factory?
No way, I'd be losing 2% on the deal. I'd be paying the bank more than the factory even earns.
Exactly. So the factory stays on paper. No construction workers get hired, no steel is bought. The economy stays flat. But what if the central bank hits that gas pedal and drops the rate to 2%?
Suddenly, my 5% profit looks great. I borrow the money, I build the plant, I hire the workers.
And that is the transmission mechanism. It's not just about you buying a car. It's about making thousands of these marginal business projects viable, all at once. That spending then ripples through the entire system. That's the gas.
But then, of course, we have the break, raising interest rates. And this is the painful part we've all been seeing recently. The central bank sees inflation getting too high. The car is speeding, so they jack up rates.
And the mechanism just works in reverse. Suddenly, that factory project isn't viable anymore. The CEO cancels it. The construction crew isn't hired. But there's another side to the break that the text mentions, which is the incentive to save.
Ah, right. The opportunity cost of spending your money.
Exactly. If the bank is paying me 0.1% interest on my savings, I might as well spend that money or, gamble it on the stock market. But if the risk-free rate is 5% or 6%, suddenly just keeping cash in the bank is a legitimate investment strategy. It sucks money out of the economy, out of the spending pool, and locks it away in the saving pool.
Which reduces demand for goods, and eventually that lowers prices. But here's the catch, and the source alludes to this lag. It's not a video game, is it? You don't just hit the brake and stop instantly.
And that is the absolute nightmare scenario for central bankers. It's called the policy lag. It can take, 12 to 18 months for a rate hike to actually be felt in the real economy.
That's terrifying. It's like driving a car where the steering wheel has a 1-minute delay. You turn left, nothing happens for a minute, so you turn left harder, and then suddenly you careen off a cliff.
That is precisely the risk. They might hit the brakes today because inflation is high, but the effect won't really hit until next year. If they brake too hard, they might crash the economy into a recession a year from now, long after the inflation problem was actually solved. They are always driving while looking in the rearview mirror.
So we have the price of money interest rates. That's the main tool. But the source brings up a second, maybe more controversial tool. And this is where we have to tackle the biggest myth in finance, the printing press.
Ah, yes. The money printer go burr meme. It's a very powerful image.
It is, you imagine a basement with a conveyor belt just churning out sheets of $100 bills?
Right.
But the text is very blunt about this. It is not just paper coming out of a machine. In the modern world, money is numbers and computers.
Yeah, we have to separate cash, the physical bills, from liquidity or reserves. When the central bank wants to inject money into the system, they aren't printing bills. They're performing an asset swap. This is what the text refers to when it talks about them buying government bonds.
Okay, walk us through this transaction, because this really does feel like magic.
So the central bank sits at their terminal. They look at a commercial bank. Let's just call it Big Bank X. Big Bank X owns a U.S. Treasury bond. That bond is an asset. It's safe, but it's not cash. It's like owning a house. You have wealth, but you can't buy groceries with a piece of your house.
You need liquid cash.
Right. So the central bank says, I will buy that bond from you. The commercial bank hands over the bond. In exchange, the central bank goes into Big Bank X's digital account and just adds zeros.
They just tape it in.
They credit the reserve account. They literally create that money ex nihilo out of nothing in that split second.
But, and now play the skeptic here, isn't that incredibly dangerous? If you just create money, doesn't that devalue every other dollar in existence? Why isn't this instant hyperinflation?
And this is the nuance that the source really emphasizes. That new money sits in the reserve account of the commercial bank. It doesn't instantly fly into your pocket or my pocket. It only becomes inflationary if the commercial bank takes those new reserves and lends them out into the real economy.
So the central bank is filling up the gas tank, but the commercial banks still have to decide to actually drive the car.
Precisely. If the banks are scared, if the economy looks bad, they might just sit on that cash. We saw this in 2008. The central bank created trillions in reserves, but inflation didn't skyrocket immediately because the banks didn't lend it all out. They hoarded it for safety.
So it's a way to flood the system with liquidity to grease the gears so that if people want to transact, the money is there.
Yes, it prevents the gears from seizing up. If banks run out of cash, the whole system freezes. ATMs stop working, payrolls don't clear. The central bank creates that money to ensure the plumbing never, ever runs dry.
It's a hell of a responsibility. You have the power to price money with rates and the power to create money with liquidity, which leads us to the final and maybe the most critical section of the source material, the vital wall.
The concept of independence.
Yes. The section attributed to Sean is incredibly firm on this. The central bank must be separate from the government. Why is this distinction so important? Why not just let the president or the prime minister decide interest rates? I mean, they were elected after all.
It comes back to the time horizon problem. Think about the incentives of a politician. What is their main goal?
Getting elected. Or, I guess, staying elected.
And their time horizon is short. 2 years, 4 years, until the next ballot is cast. If you're a politician, you want the economy booming now. You want cheap loans, high stock prices, happy voters immediately.
So if I'm the president and I control the money printer, I'm going to slash interest rates to 0 and print a ton of cash 3 months before the election.
And you'd shout, "The economy is booming, vote for me." And it works. For about 6 months, everyone feels rich. But then the hangover hits. The inflation from all that printing catches up. Prices skyrocket. Your savings are wiped out.
But by then, I've already won the election.
Exactly. And that is why the text argues that you cannot trust politicians with the money supply. The temptation to abuse it for short-term political gain is structurally, well, it's almost impossible to resist.
The source material mentions historical warnings here. It talks about the catastrophic inflation scenario.
And history is just littered with examples. When the wall between the Treasury, the government, and the central bank breaks down, you get what's called fiscal dominance. The government spends money it doesn't have, and it forces the central bank to print the difference. That is the recipe for hyperinflation. That's how you get wheelbarrows of cash to buy a single loaf of bread.
So to prevent that, we hand the keys to the technocrats.
The unelected nerds, the economists, the people who don't have to go out and campaign. Their job is to be the designated driver at the party.
The buzzkills.
Being a central banker is about being willing to be hated.
Yeah.
You have to be willing to raise rates and cause some pain today to save the currency tomorrow. A politician can't do that. A politician essentially has to say yes. The central banker's job is to say no.
It's fascinating because it's almost anti-democratic by design. We've decided that this one specific part of society, the value of our money, is too important to be left to the whim of the voters.
We've basically decided that monetary stability is a precondition for democracy, not a subject of it. If the money breaks, the whole society breaks. So we ring fence it, we build a wall and say, politicians, you stay on that side. You can decide taxes and spending, but you don't get to touch the printer.
Okay, so let's bring this full circle. We've unpacked the machine. We know they are the bank for banks.
Right.
We know they operate on a delayed feedback loop using interest rates, the gas and the brake, to balance inflation and growth. And we know that their ability to create liquidity is this high-wire act that relies on the banking system to actually work.
And we know that the entire system, all of it, rests on the credibility of that independence.
And that's the so what for everyone listening today. It's so easy to tune out news about the Fed or the central bank. It feels abstract. But every decision they make changes the physics of your financial life. When rates are low, asset prices like houses and stocks, they tend to go up. When rates are high, cash is king. They are literally changing the gravity in the room.
And just realizing that helps you navigate. If you understand the lag, you understand that today's headlines are the result of decisions made a year ago. It helps you stop reacting to all the noise and start looking at the trend.
Before we wrap up, I want to leave you with one final thought based on that vital wall. We talk about it like it's a physical barrier, but it's not. It's a norm. It's a handshake agreement that just says, we won't touch this.
And norms are fragile things.
Exactly. In an era of 24-hour social media pressure, where every decision is scrutinized and politicized instantly, how strong is that wall, really? If a populist movement decides that technocrats are the enemy and the public stops trusting the boring experts, what happens then? The source says independence is the only thing stopping catastrophe. But independence is just a word. It only works as long as we all agree to respect it.
If that trust evaporates, the mechanism breaks. And the machine has no driver.
Something to think about the next time you see a headline about interest rates. It's not just math, it's a trust exercise on a global scale. Thanks for taking this deep dive with us.
Always a pleasure to look under the hood.
See you next time.